And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary Kay, who's out today. Today is Thursday, May 15th, 2025. We've got a great show for you tonight. As always, want to thank you very much for being here. We have a little bit of housekeeping to discuss before we dive in. In case you don't get the show in your city, you can go to GaryK.com. You can listen live or archive anytime you want from any device for free, anywhere in the world that has Wi-Fi. All available on GaryK.com. You can also follow Gary on X, formerly known as Twitter. That reminds me of Prince when he changed his name. X, by just clicking the button or going to @GaryKaltbaum on X, and you can follow Gary there. There's a big banner on GaryK.com. You can click on that and just follow him there. You can also email Gary about his money management services, or if you want his premium service, you can go to convictionleaders.com. That's also on GaryK.com. You click on the big banner that says convictionleaders.com, and that'll take you to Gary's premium service, where he shares daily intraday updates multiple times every day with members, ideas, actionable ideas, nightly webcasts, weekend webcasts. He shows you charts and takes it a step further, shows you what he actually sees in real time, day in, day out, day in, day out. All that's available on convictionleaders.com if you want to take a free trial there. And if you don't like it, cancel. If you like it, keep it. All right, a few things to talk about today. From Gary, I want to make sure I get the notes out there front and center, let's see here. So first off, Meta, which is, again, another one formerly known as Facebook. Meta changed their name a few years ago, but Meta is delaying the rollout of their AI model because of concerns about the direction of their AI investments. So a bunch of AI stocks are coming in a bit on the news. AI obviously is a big driver of the bull market for the last several years. NVIDIA has been the poster child of that big move. You have other stocks that have benefited either directly or indirectly from AI, Microsoft being one of them, Meta being another one, Google has Gemini. Lots of these big tech stocks have moved into AI or trying to monetize AI. But Meta made a massive, ginormous investment in AI a while ago, and they're just delaying the rollout of their AI device, or whatever model, I guess is the right word. So that's one. Second, sentiment is very much bullish. Again, this is coming from Gary, but hasn't been that affected just yet. So today we opened lower, rallied a little bit, closed mixed. It's one of those situations where you had every chance in the world to pull back coming into today. You're super extended, super overbought. Just about every major technical oscillator, indicator, reading, levels of extension off moving averages, sentiment indicators you look at are super bullish, are one-sided. And the analogy I use, or the metaphor, the way that I explain it is, it's kind of like a traffic light. After every green light comes what? Yellow, and then a red light. After every red light, it goes back to green, and so on and so forth. The market's in the same situation where when sentiment is really bearish, like in early April or late March, it doesn't stay like that, and you get a snapback rally. Now, at the time, I wish I would have known, I didn't, that the market would have this kind of a V-shaped recovery. This is an anomaly. It doesn't typically happen throughout history, even though it's happened more and more in recent years just because of the government interference and the crazy changes of policy and Fed injecting money and whatever the catalyst is at the time. But it's rare to see a massive snapback rally. You go from being down over 20% to being down about 4% from its all-time high in about 3 or 4 weeks. That's super rare. But from a sentiment standpoint, when super one-sided, super bullish would be green light, super bearish would be a red light, typically, not always, but typically you see the pendulum swing back to the other side. So that's the next point. Third, Gary really likes the interest rates that they were tanking today. That's big. And then, let's see, what else did I want to share? We had a market at week open and came back, led by the Dow and even IBM. And let's see, the Dow was breaking out to new highs with their growth. Okay, so basically you've got a situation where the environment just had a really big move up, right? Put things in perspective. Just zoom out for a little bit. When you have a situation where you get this V-shaped recovery from April's low until now, eventually the market has to pause and consolidate that move. Not always, This could keep going straight up for another 4, 5, 6, 7, 8, 9, 10, 12 weeks. Who knows, right? You can get the Fed cutting rates, surprising people. You can get Trump having a huge trade deal with China, whatever, some other place. It doesn't matter. The point is that anything can happen. But what I want to focus on is probability. What is the highest probability outcome, and then plan and trade accordingly. Because if you're in a situation where you've got too many people on one side, again, think of it as a pendulum that swings back and forth, or any seesaw, whatever it is, people on a boat, too many people on one side of the boat, you got to move to the other side. You don't have to, but typically markets don't just go straight up. There's an old adage on Wall Street says that markets take the stairs up and then the elevator down, where they go up slowly, go sideways for a little bit, go up slowly, go sideways or pull back a little bit, and then continue, so on and so forth. What pullbacks, let's talk about those, they come in different shapes and sizes, just like rallies and just like everything else in the market. Healthy pullbacks, well, there's two kinds that I categorize them in. Healthy pullbacks and then unhealthy pullbacks. Now, what's the difference, you might ask? Well, a healthy pullback after a big move up, like we just had, you'd see the market go down. They're short, down by a little bit. So healthy pullbacks are short in size and scope. Size meaning it's a small percent decline, and scope meaning it doesn't last a long time, short in duration. That's a healthy pullback. Let's say you rally what we just did, double digits off those lows. Okay, we pull back 3, 4%, 5%, somewhere in that range. Low single digits on light volume. And then all of a sudden, you find support. Let's say now the 200-day moving average would be a clear place of support. All right, bounces off of there, or doesn't even get down there, but pulls back a little bit, and then bounces, and then just, boom, another leg higher. That's a healthy pullback. Where you had a huge move up, you pause, you pull back a little bit, and then you have another leg higher, another stair up, right? The other way you can have a healthy pullback is by going sideways. You don't have to go down. Like Gary says, there's time and there's price. So if you go sideways for an extended period of time after a big move up or down, by the way, same is true when the market goes down for a little bit, it's got to consolidate. That consolidation or that sideways period, digestion, whatever word you want to use, it's healthy. And when the market goes sideways for a little bit, that's the healthier out of both scenarios. Meaning instead of pulling back and having trouble, it could be a shallow pullback, it's not the end of the world. But if it doesn't even do that, and it just goes sideways for a little bit, that just shows you the bulls are really in control. And the market's just very strong. And then it could work off some of that overbought condition, and cooler heads can come in, and then you can have another leg up. Even if it's a 3 or 4 day consolidation, a week, 2 weeks, 3 weeks, it doesn't, there's no rule, right? But the idea is that you have a healthy pullback. It's one of those two scenarios. You either pull back a little bit or you go sideways. Now, an unhealthy pullback would be a very sharp pullback where you see distribution, which is a fancy word meaning the institutions are selling, heavy down days on heavy volume, all that kind of stuff. Kind of like what we saw in March, day after day after day, so multiple distribution days, even in February too. That's a sign, subtle sign, that, hey, the institutions are selling. Accumulation days are the opposite, where the market goes up on heavier volume than the prior session. So when you have a day where an unhealthy pullback, where you have a big move up like we just had, let's say the market goes down 10% from here in a matter of days, where it's a really violent pullback. That typically is not a healthy pullback. And therein lies the difference between a healthy pullback and an unhealthy pullback. Or it goes down, 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 and just you have that, it goes on for months and months and months and months. And it's down a lot. Another way of not being a healthy pullback. So keep those two things in mind as we go into this consolidation phase, if and when we get one. It's a matter of when, not if. Typically, based on history, anything's possible in the future. But at some point, the market tends to pause and consolidate. We don't know when, but typically that's what happens. So when you get a sideways consolidation or a small pullback after a big move up, it sets up, it gives the bulls a chance. First off, it shakes out the weaker hands. It gives the bulls a chance to step in and buy more, accumulate more shares, right? Because people don't just buy. There's pullbacks, Any seasoned market participant can tell you that, right? So you wait for those pullbacks, and then you can be buying on the way back up. So I don't buy the dip. What I do is I buy the bounce after the dip. They say, okay, Adam, you're going to get a pullback. Okay, great. Then what? I don't know how deep the pullback will be. I don't know how long the pullback will last. Actually, I was on Fox Business years ago with Liz Clayman, and she asked me the question. She goes, Adam, you have a unique way of buying the dip. You don't do it. What do? I said, I buy the bounce after the dip. Why? Because that means, oh, okay, the trend's back up again. And that tends, to, all things being equal, to be a healthier time. Again, probabilities, which we'll talk about in a second, time to buy. All right, up next, we've got a lot more to cover. I'm Adam Sarhan. We want to thank you very much for being here. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience anytime you want, all for free on GaryK.com. So, a few things. We spoke about the market having a big move. We spoke about sentiment. We spoke about the fact that the market pulls back at some point, consolidates. There's healthy pullbacks, there's unhealthy pullbacks. Next, I want to speak about something that's dear to my heart, which is psychology. Upgrading the user is one of the most important things that we do. Like, we upgrade cell phones, we upgrade our computers. You know, one of my passions in life is upgrading myself, my user, right? Because what's stopping me from being a billionaire? Myself. Nothing else, myself, right? So, okay, let me learn. I've got one job. I know I don't know how to be up 500% every single day in the market. Okay, that's not realistic. I'm exaggerating just to illustrate the point and interject some humor. But I've got one job I can learn, and that's empowering. So I want to learn and just go out there and learn and learn and learn. When I'm done, learn some more. So what is that? That's psychology. Let's talk about it. If you haven't done so, please feel free to go on Amazon. I wrote a book called Psychological Analysis. And the idea, the elevator pitch in a nutshell, is real simple. So we teach people how to make rational, not emotional decisions with their money. All right, sounds simple. Let's dive in a little bit. FOMO, fear of missing out, is one of the most powerful forces. Well, fear itself and greed are the two most powerful forces in the market. And it's not me who says this. It's Warren Buffett. It's Paul Tudor Jones. It's Bill O'Neill. It's all these great legendary investors that have just done phenomenally well. I mean, phenomenally well in the market, because they understand that humans are emotional creatures. And what happens when you're an emotional creature? We tend to make emotional decisions, and we justify it with what I call emotional logic, which is subpar logic. If you have a mind, you have biases. You have cognitive biases, is what psychology calls them. And you can Google cognitive biases and find out there's lots of them. Most of us walk around not even aware that we have biases, let alone that we're making decisions, biased decisions, right? We're making decisions with those biases. So FOMO, fear, is a very powerful driver. I'm going to paraphrase here, but if you take people, the average human, and you say, okay, the pain and pleasure, think of that. We're motivated as humans to do what? Seek pleasure and avoid pain. And you put them in a room and you say, okay, you're going to lose $5 or $10 or $5 million or $10 million or 500,000 or 50,000 or 5,000. The number itself doesn't matter. You're going to lose some money. Okay, where it's emotionally painful and it feels bad. Or you're going to make $1. They're going to do more to protect not losing than they are to go after winning. That's why the medical business is based on curing a disease, not preventative medicine, which is what we all should be doing. Eat healthy, exercise, move, stretch, take our blood work, look at our levels and reduce inflammation, get out in nature, whatever the case is, right? Everyone's different. But there's certain things we can do from a preventative standpoint. Nobody really cares until, oh no, I got this huge, awful situation. Then all of a sudden that becomes the most important thing in my world or her world. Why? Because it goes back to that pain and pleasure. People are more motivated, fancy word, or disciplined to take action from the pain standpoint. So fear of missing out, fear and greed, fear relates to pain. Fear in general, you're in a position of a highly emotional position, or a position of weakness, not strength, when you let the fear control you. Now, there's steps you can take to alchemize or neutralize the fear, and then become friends with the fear, and then turn it into from an L to a W, from a loss to a win, to turn it into something positive for you. But you got to be aware of it first. Because if you're walking around making emotional decisions all day, which most humans do, and they're thinking they're making rational ones, those emotional decisions tend to be subpar. And then when you put your money on top of it, most people are emotionally attached to their money. Even though many people I speak to in a coaching service, I got a bunch of stuff, and they're like, oh no, I'm not emotionally attached to my money. It's not me. Really? Look at your actions. And if you want to see what people really feel, look at their actions. Not their words, their actions. Oh, I want to be in great shape. Really? I want to have a flat stomach. Really, Adam? How many sit-ups do you do today, Adam? 0. Really? You want that six-pack or that flat stomach? No, you don't. What you want is to tell yourself a story and then justify, follow where I'm coming from. So, okay, if we're making emotional decisions, think of a kid, a human, right? Some kid who's crying and they're full adult is hysterical, right? Or a husband and wife are fighting and someone's really emotionally charged and someone's calm and cool. Who's going to make a better decision? Calm, cool, collected, the rational one, or the emotional one? Of course, the rational one, you would assume, right? Over enough data points, thousands and thousands of people, most likely that's the case. Well, okay, great. So if most people are making emotional decisions and then you put fear on top of it, they're going to be making highly emotional decisions. So when we have FOMO, oh man, we had a big rally, I missed it, oh no, and then enter what I call a schmelf, or the inner critic is what psychologists call it, or the dumb money beast. I have cartoon characters in my book. The book's called Psychological Analysis, and there's a smart money superhero, which is the calm, cool, collected version of yourself, the person that makes rational decisions. And then the dumb money beast is the schmelf character who runs around making emotional decisions. And I've shared the story before, but I'll do it again in case you haven't heard it, or if you forgot it. I learned that when my daughter was really young. She was 3 or 4 years old, and we stayed up late watching Beauty and the Beast, and my wife was trying to brush her teeth, and she didn't want to, because when a 3-year-old is really young and stays up too late, they get cranky, and she was having a fit, and she was crying, and she wasn't listening to reason. So I went upstairs, I did something really silly. I stood up, I don't know what came over me, I went, schmelf, and I made a stomping sound like I'm stomping on an ant. And she looked over, and I got really silly, and I really exaggerated a lot more than I just said to you there. But she goes from crying to hysterically laughing. She laughed so hard, she literally fell over. She was exhausted and all that kind of stuff, but she fell over. She got back, she was fine. She got right back up, as any 3-year-old would do when they fall. It's no big deal. And then guess what? She's laughing. We got silly. Her state changed. And now we can have a rational conversation. Hey, honey, it's a good idea to brush your teeth. Yeah, sure. Okay, great. So from now on, in our family, even now, kids are older, anytime somebody's off, we just say, oh, they're schmelfing. It's not them. We're not attacking that person. It's schmelf. All right, schmelf will pass. Take a minute, calm down, boom, schmelf passes. Being aware of schmelf in and of itself is a game changer, because now you have a deeper level of awareness into your decision-making process. And what's the result of trading and investing? It's literally the result of your decisions. The better decisions you make, in general, all things being equal, hopefully, the better things will be. So that's when there's that fear, it's important to be aware of it and then put it on the side and understand there's infinite opportunities in front of us. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, pause, listen at your convenience for free on any device. All available on GaryK.com. All right, so we spoke about FOMO, spoke about fear of missing out, spoke about some biases briefly. When you experience fear, you get into that flight or fight mode, flight or fight mode, and you get into a situation where your body and your mind kind of go into panic. Oh my God, the market's up so much and I missed out. Or the market's Whatever. Enter anything you want. This stock took off without me. I saw it. It was on my list. I had done the research. I was setting up. It was perfect. But then I got called into a meeting and I missed it. And then the inner critic comes over, or Schmelf comes in, and guess what? There's self-talk. And then it becomes a self-fulfilling prophecy of what? A negative snowball. That's what I call it. And it just gets bigger and bigger and bigger until you stop it. And once you stop it, the good news is, boom, you can stop it instantly. But if you don't stop it, if you're not aware that it's even happening, boom, game over. Why? Because our decisions control, the quality of our decisions control, for the most part, the quality of our outcomes, right? Okay, great. So when you have FOMO, stop and ask yourself, hey, is this the end of the world? Let's say I missed this entire rally. Let's say the market's up 20% this year, and I don't catch it, and I missed the whole thing. Am I going to be okay? Yeah. Normalize that fear. Acknowledge it and normalize it. Because then you can, A, realize that it's there, but B, take control. And that's a game changer. It goes from being a victim to a victor. That's what I'm all about. Turning to the L to the W, right? Upgrade the user. So, I don't have fear. Okay. There's something called personal blind spot bias. Again, Google it. It just basically means, in layman terms, that most people can't see themselves objectively. Okay. What does that mean? If you ask 100 newlyweds the night of their wedding, hey, do you think you're going to get divorced? Raise your hand. How many people think you're going to get divorced? Nobody's going to raise their hand. But statistically, we know half of them are getting divorced. So, all right, let's go back into that for a second. So they can't see themselves objectively. Same thing with people. I speak to investors all the time and go, okay, raise your hand, a room of 100 people or 400 people or whatever the number is, doesn't matter. If you think you're going to beat the market, just about everybody's hand goes up. Statistically, we know that most of them are not going to beat the market. But Adam, I'm different. Hold on a sec. I used to think that. I'll be honest and vulnerable and share. For years. Oh, it's not going to happen to me. Really? Okay. I just had I'll leave that story. I had a health situation show up out of nowhere, which was like, oh, okay, that's exciting. Thankfully it passed and I'm fine. But yes, things happen to all of us. We're human. So, FOMO is not going to impact me, Adam. I used to think that all the time. I didn't have the depth of awareness into my own self to be able to see myself objectively. Until life humbles you, markets humble you, and I decided to lean in and do the work. And say, I want to figure this out. Okay, I have a personal blind spot bias. How do I overcome it? How do I make smarter decisions? How do I get ahead? Investor's edge. How do I get an edge? And then I would write down, I realized it's something magical. Here's something to do with my coaching clients. I got write down my plan every night before the market opens, at night when the markets are closed, and then on the weekends, my heavy duty stuff. What do I want to do tomorrow? What am I focused on? Once you start doing that, all of a sudden, you now are building a muscle. You're building a muscle of putting your thoughts on paper and getting out of your head. Look, it's not my words, but Tony Robbins and Jim Rohn and all these famous people say, get out of your head. And if you don't get out of your head, you're dead, right? So to get out of your head is freedom. Put it on paper. Write down even a sentence, 2 sentences, even a stock ticker, 2, 3 letters, 4 letters, with a price, my pivot point. If XYZ goes above $100, I'm going to buy it. All right, you get a target list of 4 or 5 stocks, 10 stocks, whatever the number is. Everybody's different. And then what? Tomorrow, when the market opens and things happen, life happens, you get busy, you're around, not around, the market goes, so many stocks are breaking out, this, that, whatever the case is, go back to your list. Hey, here are the stocks that I was focused on. How many of them took off without me? Did I catch them? Did I set alerts? Did I have structure, folks? This is a key metric in improving performance. We're in a performance-based business. People in our business get paid extremely well. Steve Cohen bought the Mets because of his profits in the market. investing and trading. And literally, it's a performance business. You get paid extremely well when you perform well. And if you don't perform well, no bueno. You lose money or you don't get paid well. But if you can perform well, great. So if we're playing basketball, we want to shoot free throws, play basketball. You want to shoot 3-pointers, get better, get a coach. Every major performance-based business outside of investing that I know of, at least, acting, athletics, sports, all these, the list goes on and on. Typically, they have coaches. Okay. Why? Because when you learn how to get out of your head and you can have somebody help you that can actually help you make better decisions, guess what? You can see your strengths, you can see your weaknesses, you can see your blind spots. Ray Dalio, the biggest hedge fund manager of our generation, literally says these 3 things. We all have strengths, weaknesses, and blind spots. We want to find those blind spots. What am I good at? What am I not good at? What am I missing? And how do I stop missing it? And that work over time becomes gold. So if I write down a report and I'm saying, or just my thoughts on the market, and I email it to myself week in, week out, guess what happens? There's now accountability. Napoleon Hill talked about this 100 years ago in Think and Grow Rich. He goes, one of the most important things is to have accountability. Oh, I missed it. I saw this. It went off without me. Oh, this, that. I used to do that all the time, and I was in my head all the time. And I wanted accountability. So what I did is different than what most people do. I started an email service. I said, okay, well, findleadingstocks.com. I said, I'm going to share my thoughts with people, and there's my accountability. There's archives of my thoughts every day, and I want to see what stocks are breaking out. I want to do weekly videos. I want accountability, and I want to share them with people. When people were asking me what my thoughts were at the markets, I'm like, okay, let me just do this. It's a good way of getting the message out there instead of responding each individual email, and it just became too much. Okay. Now I can go back. What was I thinking on April 7th or April 9th or April 15th or yesterday? Were my actions, and this is important, aligned with my thoughts? I want to have a flat stomach. Really, Adam? How many sit-ups you do today? Oh, none. What do you really want? I want to make money trading, investing, this, that, and the other thing. Okay. Let's look at your actions. What's the structure that you have in place to help you protect yourself from yourself, so to speak, right? From schmelf, from the emotional side of us. We're all humans. These are some of the things that have really, and I'm sharing these things because I don't come on often, but when I come on, I want to give you timeless advice. That's what really drives me. I love it, and it gets me going because, okay, if I can help one person, it's a win. Living is giving, another thing Tony says and other folks say. And it's true. You get to a certain point, you really get satisfaction of helping others, and living is giving. Think of 2 people. Take yourself out of the equation. 2 people that are investing. One person has a plan, writes down his thoughts. The other person doesn't have a plan. Who do you think is going to have better results over the long term? The person with structure and accountability, or the person that just wings it and has no structure and no accountability? Again, remove the personal blind spot bias. It's not a matter of intelligence. I have many doctors, lawyers, I have PhDs, I have people that are infinitely more intelligent. I don't even know the number. I mean, by 10x, 100x more intelligent than I am. It's not a matter of intelligence. In fact, sometimes intelligence in this business is harmful, not helpful. Why? Because many times people that are very, very, very smart in their fields, whatever their fields may be, let's say they're doctors, lawyers, accountants, nuclear engineers, which I have, you're just in a situation where, oh, okay, I'm really good at X, but you come to the market, it's a different skill set. It's not just about the intellect, it's also about the emotional stuff, because that's what drives the decisions. I don't know anyone that buys a stock and say, oh, I hate this stock, I'm going to buy it anyway. All right, I hope this is helpful. Up next, we've got a lot more to cover. I want to thank you very much for being here. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, or listen anytime at your convenience, from anywhere. All right. A few minutes ago, I had a big helicopter that passed, so I apologize if that noise interrupted us, but it should be good now. All right. So it was really low, too. It was very strange. But anyway, we're good now. So a few thoughts here. We spoke about markets. We spoke about the importance of making rational, not emotional decisions. I spent a lot of time on that because it's really important. And what I've learned over the decades, I've been doing this since the 90s, is the more humble we are, the better we tend to be, number one. But number two is the more that we're open-minded and willing to look at things differently, that's where growth comes from. Now I want to talk about breakthrough and growth, right? If we keep doing the same things, Einstein says, and you're expecting different results, that's the definition of insanity. Nobody wants to be insane that I know of, especially not investing in trading and has that edge and wants to get ahead and do better and level up and all that stuff. All right. So another step, not just step one, but another step is observe. And the best way to get out of your head that I know of is either talk to somebody or write it down. And it doesn't have to be long paragraphs. In fact, sometimes the shorter the better. Observe not only your thoughts, but your actions. And then more importantly, your habits. Well, not even more importantly, equally important, your habits. So it's thoughts, actions, and habits. If I wake up every day doing the same thing, having the same thoughts I did yesterday, doing the same actions I did yesterday, eating the same food I ate yesterday, and trading the market the same way, I'm a busy guy, I'm doing this, I'm doing that, but I'm squeezing in some trades as I'm running around on my phone, and I'm not getting the results I want. And this is the critical part. It behooves me to do what? Change. It's not easy to change, because then that ego comes in. Am I wrong? I'm not wrong. I'm not bad. I'm not. No, just pause. Reflect for a second. We're human. We can grow. In fact, growth is good. I'm not the same person I was 20 years ago. I'm not the same person I was 10 years ago. I want that edge, right? If someone's a pilot, I have clients that are pilots I work with, 1 degree off could send you on a completely different destination. So if you can get 1% better every day over the next 10 years, 30 years, 40 years, what's going to happen? Hopefully, you continue to grow and improve and evolve and become the best, upgrade the user, become the better and better and the best version of yourself. It's endless, but keep upgrading. Okay, great. And then what happens? Along the way, we get breakthroughs. And what are breakthroughs? You ever get stuck doing something and you hit a wall? Of course, I have. Who hasn't, right? It's part of the learning curve. You learn how to do anything. Learn how to play tennis, learn how to ride a bike, learn how to do math, whatever it is. You learn it, you get a certain level of proficiency, and then you hit a wall. Most people stop because that's pain, and they just move away from it. Successful people understand that it's natural, and they push through. They become friends with what's stopping them, their blocks. And they alchemize them, they neutralize them, they turn them from L's to W's. Instead of being painful, whatever that event is, or that habit is, or that pattern is, let's become friends with it. Let's acknowledge it. Let's give it space. And then flip it. And let's take control of it. And if that habit doesn't serve us, what do? Keep doing it if you want. Better option is upgrade. Find a new habit that serves us. When I was younger, in my teens, I used to eat a lot of carbs. Rice, bread, and I was much heavier. Guess what? I learned calories. One of the most important formulas in the world. I love simple things. Cash flow in versus cash flow out. Everyone's like, I want to be richer. I want to be richer. Someone makes $10 million a year. They spend 11. They're minus 1. It's not just about making more money. It's about controlling what goes out, right? Calories in versus calories out. The same thing. I want to lose weight. I want to lose weight. I want to lose weight. It was me for years. All right. What are you eating? What are the calories in? You can have 300, an hour on the treadmill burns maybe 200, 300 calories. I can eat that literally in one donut. It blows my mind. So, all right, I educated myself. I'm going to change, adopt a lower carb diet, lower calories, and understand the formula, calories in versus calories out, if that's my objective. I could have easily said, I always eat carbs. I'm going to keep eating carbs. All right, if you want the same results, keep doing that. If you want to change, you want to break through, want to get to the next level, that's where it's not easy. It's simple. not easy. Just like riding a bike, just like learning anything. At first it's hard, then it becomes easy. Now you can ride a bike if someone knows how, piece of cake. Teach a 7-year-old or 5-year-old how to ride a bike? Yeah, not the easiest thing in the world. But if they keep doing it, guess what? They'll get it. Just about guaranteed. Same thing with learning just about anything. At first it's hard, then it's easy. Not always, not everything, just to be clear, but lots of things, right? So creating new habits and doing inventory of what's serving me, what's not. How am I getting better? If I keep doing this, am I getting that 1% better or 5% better? Am I improving? Am I getting closer to my goals or further away? Here's the data in the market. How am I interacting with it? Take the politics out for a second. How am I interacting with the market? Am I in control? Not in control. What am I doing? What are my routines? Again, routines. People are creatures of habits. Do I have L habits or W habits? How do I change those habits? So on and so forth. That's the type of work that anybody, just about anybody, can do. And I recommend people do it because that's where the breakthroughs come from. And when you start adapting new habits over time, it compounds. I spoke to the kids at my daughter's school, a bunch of 7th graders, a few weeks ago, or from a few months ago at this point, but about career day. I said, okay, how many wonders are there in the world? To a bunch of 7th graders, 12, 13-year-old kids. 7 wonders in the world. All right, here's the 8th wonder. Compounding. Showed them how money compounds. At the end, I was like, knowledge compounds. Relationships compound. Mind, like the head emoji on the iPhone, that mind explodes kind of a thing. They loved it. And it's so true. It's so powerful. So again, I hope all this helps you. The idea is to find out the data that's coming in, filter out the noise, get rid of the data that doesn't serve us, the low ROI data, focus on the most important things that really matter. What moves the needle? And then do that assessment. Where are my strengths? Where are my weaknesses? Where are my blind spots? Need help? Reach out. There's people that can help you. And then what happens? Once you become aware of something that doesn't serve you, it's a choice. Happiness is a choice, right? Success is a choice. That habit is a choice. I'm not going to do it anymore if it doesn't serve me. Anyway, I believe that's all the time we have for today. Thank you very much for being here. This is the one and only Investor's Edge.